Hi, my name is Young, and today I'll be conducting my analysis on Peachtree Securities Case B for my FIN139 class. Question 1A. To calculate the nominal rate of return, we first have to determine the annual dividend, which is the cumulative dividend multiplied by the par value, $100. Next, we take your annual dividend and we divide it by 4, as it is quarterly, to obtain your quarterly dividend, which gives us $1.08. Quarterly return is your quarterly dividend over the current market stock price. Therefore, our quarterly return is 2.25%. To obtain our nominal rate of return, we multiply that by 4, which gives us 9%. Next, our effective annual rate of return. The formula is given in the slide as shown, and 9.31% just by plugging in I, which is 9%, and N, because dividends are quarterly, it's 4. Question 1B. Given the data from the question, in order to determine the current value per share, I first begin with using 60,000 shares over 300,000 shares outstanding to obtain 0.2/20%, which I use to multiply by my par value, $100, and to get $20. Next, I use $300,000 and I divide it over $300,000 multiplied by the cumulative dividend, which is 9.75, and that gives me $9.75. And I add that to 20 and I get $29.75 for the first period. As you can see in the slide, I calculated the rest of the periods up to period 5, and therefore the value per share on the 1st of January is $21.95. Question 2A. Using the constant growth model's formula, dividend per share over initial stock price plus growth, we can determine that dividend per share is $1.80, initial stock price is $22.26, and growth from your 5-year dividend is 6%. Therefore, your expected rate of return will be 14.09%. Question 2B. The expected dividend yield can be computed using the following formula. Dividend per share over initial stock price, which is 180 over $22.26. Therefore, the expected dividend yield on the 1st of January 1992 will be 8.09%. Assuming that this is a common growth stock, the expected capital yield will be the 5-year dividend growth rate, which is 6%. Question 2C. Under constant growth assumptions, the dividend yield stays constant as the dividend and the stock price is expected to grow at a constant rate. As I stated from the previous question before, the expected capital yield is constant and is the 6%, which is the 5-year dividend growth rate. Both dividend yield and capital gains will remain constant over time. Question 2D. Using Gordon's growth model, we use a constant growth assumption as an estimate because using this model requires that the dividend per share will grow at a constant rate indefinitely. The real-world stocks that satisfy the constant growth assumptions are usually big or larger companies because that's when we apply the constant growth assumption as an estimate. Question 3A. So what is the value of the TICO stock on January 1st, 1992? First, we have to calculate the stock price of year 5, and we cannot apply the constant growth model anymore because that 5 years is over. So that 6% growth is non-existent anymore. That's why we replace it with 7.5%. And with that formula, it gives us a stock price of $40.72. And as you see from my calculations of the present value of cash flows, we get a value of TICO stock price on January 1st, 1992 of $28.56. Question 3B. The expected stock price at the end of 1992 is $30.62, as you can see from my calculations. Therefore, we can assume that TICO stock is undervalued as the expected stock price is $30.62, which is greater than the current market stock price, which is $22.26. Question 3C. The expected stock price at the end of 1993 is $32.85, as shown above in my calculations. The only difference this time is that we use the dividend. We start off with a dividend of 2.022. And as you can tell from the previous stock prices in the previous years, you can see a trend of increasing value in terms of stock price. Question 3D. To compute the expected dividend yield, we use the formula dividend per share over initial stock price. Dividend per share is $1.80, and initial stock price is $28.56. Our expected dividend yield will be 6.3%. For capital gains yield, we use the formula stock price off the first period, subtract by initial stock price, divided by initial stock price. Our stock price off the first period is $30.62. Our initial stock price is $28.56, as stated earlier. That would give us a capital gains yield of 7.21%. And then we add our expected dividend yield and our capital gains yield to get total return, which is 6.3 plus 7.21%, which gives us 13.51%. Question 3E. If the required rate of return is 13.5%, would TICO's stock value be higher or lower than your answer in Part A? So to begin this question, we calculate the dividend year 6 by taking $1.80 and you multiply it by 1 plus 6%, which is 1.06. And our dividend for year 6 is 1.908. We take this value and we divide it by the required growth subtracting growth, which is 0.135 minus 0.06, and we get a stock price of $25.44. We then add our stock price to our dividend price, which gives us $25.44 added to $1.80, which gives us a value of $27.24. And as you can see from my calculations of the present value of cash flows in the slide, we get a value of $19.76. The only difference about this present value calculation is that the dividends are constant, and that stock price of $19.76, that implies that TICO stock is overvalued at the current stock price of $22.26. To determine the stock's expected rate of return, we use the following formula: dividend per share over current market stock price plus growth. So our dividend per share is 2.443. The current market stock price is $22.26, and growth is 7.5%. Therefore, the expected rate of return is 18.42%. Having such a high expected rate of return will attract investors. Question 3G. Based on the information provided in the value line tables, to assume 6% growth rate seems to be reasonable because the historical trend seems to favor higher growth rates, even though the dividend growth rate for the past 5 years has been at 6%, while the dividend growth rate the last 10 years has been at 7.5%. Question 3H. The return on equity is already given 16%, as you can see from the slides. Then we have to determine the dividend payout ratio to begin this. So dividend payout ratio is dividend per share over earnings per share. And that gives us an answer of 0.6818. And next we look for retention ratio. As you can see from my calculations above, the formula is 1 minus the dividend payout ratio. So that gives us an answer of 0.3182. To find sustainable growth, the formula is return on equity multiplied by retention ratio, which is 60% multiplied by 0.3182, and we get an answer of 5.09%. This implies that the growth rate of 7.5% might be a little overvalued for a growing company. Thank you for taking your time to listen to my presentation.